Zoom people, can you hear me? Hello, hello. Hello, can you hear me? Okay. I request all students to kindly switch on your videos. Today we are starting with new chapter. The name of the chapter is Bond Valuation. Okay, so in your notebooks I will request you all to kindly give heading of the new chapter, Bond Valuation. Bond Valuation. Okay, can we start? Okay, so from today onwards we are alone. There is no Mumbai here, so only we and I and you people will be there. So this is going to continue now. Okay, now as far as this chapter is concerned, from ICAI's point of view, it lies in a chapter called as security valuation. You are able to hear me, no? Because my throat is not proper today. I'm speaking very softly, but I hope you are able to hear me. Okay, so in ICAI module there is this chapter called as security valuation. Now in security valuation there are two parts, bonds and equity. In that we are first doing bonds. In our JKSC textbook also, the first chapter you will see security valuation. There are two parts, part A and part B. I am doing part B first. Okay, I'm doing bond valuation first, and then we'll go on to equity valuation. Okay, so as far as today's lecture is concerned, it is what 7-hour lecture. 7-hour lecture means I will total give you 45 minutes break. You're understanding? Now 45 minutes break, we will bifurcate it in two parts. One is 15 minutes and one is half an hour. Okay, so my recommendation is that around 9:30 we will take our 15-minute break, and then 9:45 onwards till maybe around 11, not 11, if possible till 9:45 till 12, that is basically 2 hours 15 minutes, we will go for second session, and then we'll take half an hour break at 12 o'clock, and during, so that you can have your lunch also, so 12 to 12, so you can tell your parents also at home or wherever you are staying, at hostel or wherever. 10 to 10:30, 12 to 12:30 is okay now for your lunch, and then 12:30 to 2, last 1.5 hour session we will do. Is it comfortable to all? Yes. Okay, so we will now go on till 9:30, 2.5 hour session. Okay, all right. So bond valuation. Now what is this chapter all about? Let us try to understand. Students, first of all, what do we mean by bonds? Bonds refer to fixed income securities. Fixed income securities means what? Meaning here if you invest, can I say you will be getting fixed interest. How is it different from equity? It is different from equity in many functions. First, it does not give you ownership of the company in which you are investing for a bond, unlike an equity. In an equity, as you know, when you invest you get the ownership, you get voting rights, etc. Here you continue to remain an outsider. Second, it is much more safe in terms of uncertainty versus certainty debate. Can I say there is a lot of certainty regarding what cash flow you will get if you invest in a particular bond or a debenture. Okay, why there is certainty? There is certainty because, just 1 minute. Okay, ready everyone? So yeah, there is certainty. Why there is certainty? Because there is fixed interest. Correct? You will be receiving fixed interest. So since inter CA started, we people were looking at debt as the one who causes risk to the company, financial risk to the company. Because, can I say, in debt, when a company raises money through debt, they have to pay fixed interest. Correct? And this concept of paying fixed, irrespective of how the business is functioning, we have to pay fixed. That causes stress and risk and financial leverage and gearing and all these words you have heard in inter CA to the company. But now for the first time we are learning a chapter from the other party's point of view, that is the investor's point of view. So can I say the company is taking over risk, but for the investor it is a safe investment. Everybody clear? They feel very safe in an investment in a bond. Now in this chapter, what are we going to do about bonds? Okay, there are a lot of small concepts that we need to study regarding bonds. In CFA level 1, this particular area is referred to as fixed income securities. Fixed income, you understand the meaning of the word fixed income? Fixed income means you will always get fixed interest. Okay? That is the whole concept. So now today for the first session, okay, which is going to be till 9:30, what are we going to discuss about bonds? Students, we are going to be discussing something called as bond valuation. Now you will say, sir, the chapter name, no? Chapter name is bond valuation, but the whole chapter is not dedicated to valuing bonds. I hope you are listening to me. In the whole chapter there are a lot of other things regarding bonds, but in the first 2.5 hour session we will only be dedicating our time for understanding valuation. Now fortunately or unfortunately, in inter CA also ICAI has put this session. It is in this chapter called as cost of capital part 2. Now if you are in JKC, we had bifurcated the chapter of cost of capital into 2 parts. One was cost of capital and one came after capital budgeting. So that part is what is basically the intro, or I might say the first part of this particular chapter. But don't worry, I will not assume anything. For some of you, you might feel, oh, I know. For some of you will say, now I remember. For some of you, it will be complete new knowledge. So hence, due to that reason, I will assume that nothing you know, and I will start from scratch only. So for some children, it might appear slightly slow. The reason is, you might say, sir, we know this. But please know that there could be some people who might not remember or who might not know, etc. Okay? Alright. So when we talk about the word valuation, what does valuation mean? Okay, so let's say this is a bond. Okay, Tata Motors has issued a bond. I want to know whether I should buy this bond or not. Now the question is, how do I know whether this bond should be bought or not? Okay, one should simply ask 2 questions. Question number 1, what is the price of this bond? Second, what is the value of this bond? Oh, sir, what do you mean by that? Price means what you have to actually pay to buy the bond. Value means what you are ready to maximum pay for the bond. Are you all able to understand? There is a difference. Price means what you have to actually pay for the bond. Value means what you are ready to max pay for the bond. Everyone clear? Do you all understand that if price is less than value, then you will buy the bond? If price is more than value, we will consider it to be overpriced and we will reject the bond. Everyone clear? So that is the whole theme. Now, do you realize comparing the price with value is a simple thing? Understanding the price is a simple thing because that the bond will tell you. But do you realize our expertise will lie not in comparing price with value, not in determining the price, but in calculating the value? Everybody, are you able to understand? Price, do you realize, is set by the company at the time of issue, or in eventually it is determined by the demand supply function in the market. Everyone clear what I'm trying to say? But the value, what you think, oh, according to me this is the value of the bond, according to me this is what I am ready to max pay for the bond, I will not pay a single rupee above this. That value, students, can I say, is what we all need to study today. Everyone clear how to calculate value? I hope you realize the only reason why we would want to calculate value is so that we can compare it with the price, so that we can determine whether we should buy or ignore the bond. Everyone clear? Now that you have understood what is value, now we will enter into the mathematics of it. How do you calculate valuation? How do you value? Now I will first of all, children, teach you basic principles of valuation which are applicable not only for bonds, but they are applicable for equity, companies, anything you want to value. Now you can do that. Everyone ready? So the general rule of finance, okay, the general rule of finance is value of any investment equal to present value of all future cash inflows from that investment. I'll again repeat. Value of any investment is equal, I'll give you notes, don't worry, just right now listen. Value of any investment you buy, by now I hope you trust me on the notes, don't worry, detailed notes I'll give you. So value of any investment is equal to present value of all future cash inflows from that investment. So through an example, I'll first teach you this one basic principle, which is the foundational principle of the chapter, okay, time value of money and all that. So focus. See, let's say Tata Motors has issued a zero coupon bond. Do you know what is a zero coupon bond? ZCB, not JCB, ZCB. What is ZCB? ZCB is basically a bond which is issued at discount, redeemed at par. Okay, issued at discount, redeemed at par. They will not give you any interest. Are you there? They will not give you any interest. In finance, interest is referred to as coupon, COUPON. So zero coupon means zero interest. Then how will the debenture holder earn money? The discount is there in interest. Everybody clear, na? So basically they will get discount to earn. So let's say Tata Motors issues a 5-year zero coupon bond having a face value of rupees 1 lakh at a 20% premium. I'm sorry, not premium, but 20% discount. Okay. Premium, who will buy the what? Okay, at a 20% discount. Should you buy the bond if your minimum required rate of return is 8% per annum? Okay, please read the story once, then I will explain details. Ready? So who are you? You are a person who wants 8% per annum return, correct? You say that I don't know, I want 8%. Now I say, okay, hey, there is a Tata Motors ZCB that has been launched. You have to pay only 80,000 today. Are you able to understand? You have to pay only 80,000 today, and in 5 years it will grow to rupees 1 lakh. In 5 years it will grow to rupees 1 lakh. Do you want to buy is the question. Okay, do you want to buy is the question. So students, there are three ways in which we can understand whether we want to buy or not. What I'm teaching you now, students, is actually very basics of inter-CA time value of money. Please be with me. So, and please don't think that I don't have anything else to teach. That is why I'm teaching inter-CA. Please listen. These are all basics which will help you understand this chapter and future valuation chapters better. Okay. Otherwise, you'll have to buy at things. Listen carefully. So the first way by which I will explain to you is by using the concept of future value. Okay, by using the concept of future value. What is future value? Future value is equal to present value into 1 plus r raised to n. You have heard this? Future value is equal to PV into 1 plus I or 1 plus r raised to n. Now, what are they asking you to invest today? Can I say they're asking you to invest 80,000 today? 80,000, can I say, becomes the present value into what is the rate of interest you want? 8%. So into 1.08, and we raise it to 5. Can someone please give me this number? One lakh 17,546. Thank you so much. 1,17,546. Everyone got this? Now let's discuss about this number. Okay, see. This is year 0. This is year 5. Today, can I say they are asking you to invest 80,000, and they are telling you that it will grow to rupees 1 lakh in 5 years. Everyone understood story? Can someone think and tell me what is the meaning of 1,17,546? And I hope you realize 1,17,546 is a number after 5 years. Huh? Hello, it's a future value. What do you mean by this? Come on, take your time. In this context, in this question's context, what is the meaning of 1,17,546? No. Or maybe yes. Maybe you are trying to say something. I am trying to interpret it separately. No. Wait, you are all mathematically, you are all correct. But in this context, in this context, what does this mean? So you are telling me, sir, 80,000 will grow to 1 lakh 17. Mathematically, you are telling right. Okay, I will. No. Nikita, yes. Mahalakshmi, yes. Great. Now the meaning that I wanted is like this. That, sir, if you are asking me to invest 80,000 today, then considering the fact that I want 8% per annum, I want my 80,000 to grow to this much. I hope you're understanding. I want, my desire, requirement is that it should grow to 1,17,546. However, it is growing to only rupees 1 lakh. So tell me, are you getting your 8% here, or are you not getting your 8% here? Not getting, correct? So I will say, since we are not getting 8% per annum return, bond will be rejected. What do you think? You're understanding, everyone? Bond will be rejected. So this is one way, future value route, through which I taught you how to say yes or no to a bond. Everyone clear how to say yes or no to a bond? Now students, we will go to the second route. The second route that I'm going to teach you is called as the present value. Okay, present value route. Here first route was what? Using FV. Now I will say using PV. Okay, using PV. Now, how do we calculate present value? Do you remember you used to do a table in last year? Year, cash flow, DF at the rate 8%, present value. Do you remember this table? Everyone has gone through it now. From whoever has taught you, wherever you have learnt it, this table you must have seen, correct? Okay. Students, do you realize that we are calculating present value of some future value? Are you all there? Now, here in this story, between 80,000 and 1 lakh, the future value is not 80,000, the future value is 1 lakh. So, do you therefore realize that after 5 years, I will be getting rupees 1 lakh, correct? After 5 years, I will be getting rupees 1 lakh. Students, anyone knows how to find discounting factor? It is 1 divided by 1.08 raised to 5, correct? 1 divided by 1.08 raised to 5. So I take my calci and I do 1 divided by 1.08 and I press equal to 5 times. 1, 2, 3, 4, 5 and I get 0.6806. Okay, 0.6806. Everyone clear? 0.6. Why are some people getting different answers? 1 divided by 1.08 press equal to 5 times. You have done this now earlier. See, thank God I'm revising. 1 divided by 1.08. If you're not getting, please let me know. Got it? So then what to do with this number? I should simply multiply this 1 lakh by 0.6806 and I will get 68,060. Everyone clear? 68,060. All done. Now just before I go ahead, even when we were doing forex, was there any calculation of present value that we were doing anywhere in forex? You remember money market hedging? In money market hedging, you know, we had to create a foreign currency receivable or payable. For that we had to invest or borrow present value. Remember that? So in that also it was like this only, 1 lakh divided by 1.08 raised to 5 lakh. So something like that only used to happen. I hope you're realizing. Here it appears that you're multiplying, but end of the day you're doing this only. I hope you're getting it, huh? mathematically. It appears that you are multiplying, but actually you are dividing. Everybody clear? Okay. So for those who remember, this number that you got now, 0.6806, is called as the discounting factor. It is called as DF, and it is 8% fifth year DF. This language you understood? DF, discounting factor. It is also called as PVF, present value factor. PVF, some people call it as PVIF, present value interest factor. Like that, different names are there. Anyways, so we got 68,060. Everyone ready? Okay. Now students, time for diagram. Okay. This is year 0. This is year 5. Okay. In year 0, they are asking you to invest 80,000. In year 5, they are saying they will give you 1 lakh. Can you tell me on chat box, this 68060, this number is a year 5 number or a year 0 number? This 68060 is year 5 or year 0? Year 0, thank you. It's present value, correct? It is present value. So I'll write here 68,060. Okay, 68,060. Now I want you to think hard and tell me, what do you mean by this number? Don't tell me it is present value. I know it is present value. Think from the story point of view. What could this number interpret? How to interpret this number? Take your time to think. Oh wow, Pranav, you hit the nail. Super, perfect answer. Adarsh, a perfect answer. Thank you. Thank you. Very nice. Divya, correct. Perfect answer. Very good. Sandeep, perfect. Mohammed, yes, correct. Raghunandan, perfect. Yes. Urmila, yes. Nikita, yes, correct. Wow, you're giving superb answers. All of you, none of you gave wrong answer. Very nice. Thank you. So, Mahalakshmi, yes, correct. Perfect. 100%. So, what is 68060 now? Now, I have created 4 interpretations of what 68060 is. I'll tell you one by one everything. Listen carefully. So, interpretations. You are not feeling bored, na? After Forex, na? After Mount Everest, I brought you down to Marina Beach. So you are not feeling left out. Or what is this? All this, sir, some finance, final. I'm coming up, please. Just basics now we need to first get. Even in Forex, if you remember, first 6 hours we've only dedicated to basics. Only then we had the, courage to go ahead. Ready? Okay. So, interpretations of PV. So, what are the 4 interpretations that I have created? Please pay attention. The first interpretation is, today na, before we leave at 2 o'clock, somebody please remind me, mutual fund chapter is over. So, within mutual fund, 2 things. I'll share my entire PDF now. Some people were asking me yesterday. I'll share that PDF in case you want it. Anytime anything is there in that, I don't know. I'll put it on the Telegram group. Just remind me today. I'll send to Suman ma'am. Secondly, I'll also check if I can, get some test paper. Your understanding for mutual funds, or maybe we can just solve last 3-4 attempts papers in which mutual funds were asked. You getting it? In which mutual funds were asked. We can do that. Okay. All right. So, but in a sense, solve in a sense you will have to do at home. We will not be having time in the classroom. Okay. So, interpretations of PV. Now, first interpretation is the most basic interpretation. Ready? Most basic interpretation, that 1 lakh rupees that we will receive after 5 years is worth only 68,000 today. Understood first? This is like foundation interpretation. 1 rupee after 1 year is not worth 1 rupee today. It is worth less. So if someone tells me, do you want 1 lakh today or do you want 1 lakh after 5 years? I will say, give me 1 lakh today only, because 1 lakh after 5 years now is worth only 68,000 today. Everybody clear? That is the first interpretation of PV. So I'll write here, rupees 1 lakh received after 5 years is worth only rupees 68,060 today. Okay, this is interpretation number 1. Interpretation number 2, as many of you said correctly, sir, if I want 1 lakh after 3 years, after 5 years, if I want 1 lakh after 5 years, then today I need to invest 68,060 if the rate of interest is 8%. I hope you are able to understand. If rate of interest is 8%, bank, let's say there is a bank is giving me 8% interest, and I want that my investment should grow to 1 lakh. My daughter's marriage is there in 5 years, and therefore I need 1 lakh rupees after 5 years. So I go to the bank today only and I say, bank, I want to deposit some money today only, so that after 5 years no, it should grow to 1 lakh. Can I say the number that the bank will quote is 68,060? Everyone clear? 68,060. So I'll write here, if we want rupees 1 lakh in 5 years, then we need to invest rupees 68,060 today if R equal to 8%. Everyone clear? Okay. Now I want to tell you something. You know, na, in India, if you want to consult financially, I told you, remember, you require that license, and due to that I have that license and how I practice consultancy. So just I'll give you an example. Let's say one day one uncle comes to me and says that, okay, his daughter's marriage is there in 5 years. I say, how much rupees you want to spend? He says 1 lakh. I say, okay, how much is your bank giving? He says 8%. I do this math, I do this calculation, and I'll tell uncle, please invest 68,060 today in the bank. Everybody clear till here? Now uncle says okay. He goes to the bank, he makes that check of 68,060 to deposit. The bank person there is asking, let's say there is a lady sitting there, she is asking, uncle, why are you depositing this? For some reason. He says, yes, I have a daughter your age, she's going to get married in 5 years, so for that I need to, 1 lakh rupees I need after 5 years. For that I am investing 68,060. So she says, oh, but uncle, what is your age? And let's say uncle says age is around 62, for example. She says, uncle, you are senior citizen, for example. So he says, yeah. She says, for you the rate of interest is not 8%, it is 9%. For example, for you the rate of interest is not 8%, it is 9%. So uncle says, oh, and immediately tears the check. He comes running back to me and says, I'm sorry, I gave you wrong interest rate. The interest rate is not 8, it is 9. Now, without using Calci, you have to tell me on chat box. See, first of all, the number will change. You understand, no, everyone? Number 68,060 number will change. My question to you is, will the number become more or less? Think logically. Uncle needs 1 lakh. Uncle needs 1 lakh after 5 years. If 8% is the interest rate now, then today he has to invest 68,000. They are saying no, interest rate is 9%. So he has to invest more or less? Of course less. Very good. Understood now? Of course less. So by this example, you know what I wanted to prove? It will be helpful for today's lecture second half. That the rate of interest, or I might say the rate of discounting, if it increases, can I say present value decreases? Everybody, are you able to understand? Rate of interest increases, not the rate of interest of the bond. I am saying rate of interest, required rate of interest. You understand? Your required return, opportunity cost. If your opportunity cost discounting, basically discounting rate, the rate at which you are discounting factor at the rate 8%, if that becomes 9, R increases, present value decreases. As some of you have correctly remembered foundation, R and PV, okay, R and PV have inverse relationship. This line everyone understood? R and PV have inverse relationship. Very good. Now students come into the third interpretation. Interpretation of what? Interpretation of 68,060. Now I am going to write it down. Please nod your heads if you understand what I write. Everyone ready? Okay. Please read. Let me know if you are understanding. You're able to get it? So I am saying to this zero coupon bond, dear bond, you are giving me 1 lakh after 5 years. See, I want 8% return. Considering that I can maximum give you 68,060 today, because children, you understand na, 68,060 plus 8% plus 8% plus 8% plus 8% plus 8% is 1 lakh. Present value, the present value of future value, the future value of the present value will be future value, no? You are understanding? Like 68,060 is the present value of 1 lakh. 1 lakh is the future value of 68,060. Everybody clear? So the point I'm trying to say is, if I invest 68,060 plus 8% plus 8% plus 8% plus 8%, it will give you 1 lakh. And considering that I want that only, maximum I'll give 68,060. Acha, why am I using the word maximum? Because dear Tata Motors bond, if you ask me to invest less than 68,060, with a big smile I will invest. I hope you are understanding. Because then I will be able to generate a return more than 8%. But if you ask me to invest something more than 68,060, then I will not, because that journey will not give me a return equal to 8% or more than 8%, it will give you less than 8. Everyone clear till here? So you understood this line now, everyone? Max I am willing to pay, not a rupee beyond it. Okay. And then students comes the last interpretation, that is interpretation number 4. Rupees 68,060 is the value of the bond according to me, who wants 8% per annum return. I hope you are understanding. According to me, this bond's value, not price, value is 68,060. I am ready to max give 68,060. Students, I hope you realize here price is rupees 80,000. Bond is considered overpriced and will be rejected. Am I making sense? Price and value difference you all understood, no? Price is what they are asking you to pay. Value is what you are ready to max pay. Got clarity? Everything clear? 4 interpretations understood? Okay. That is as far as this particular PV is concerned. Now I've got one more way. See, the first way of understanding whether a bond should be accepted or not is using FV. The second way is we saw using PV. Now the third way I'll teach you. Okay, third is inter-CA using NPV. Oh yes, you remember this NPV? So what is NPV? Year particulars. There is no calculation column required here, so I'll straight away go to cash flow, DF at the rate 8% present value. In year 0, can I say you do your initial investment? Now initial investment in this bond is basically the current market price. I hope you're understanding the current market price, or you might also in this bond call it as the issue price. Everyone clear? Issue price. Do you realize you have to invest 80,000 today? The discounting factor is 1. I hope you remember anything that happens today, DF is 1 because number of years is 0 now, so it is raised to 0. Anything raised to 0 becomes 1 now, like that. And this is, can I say 80,000 again here? And then after 5 years you will be getting the redemption value of rupees 1 lakh. The discounting factor is 0.6806. This is 68,060. Correct? And this is basically your NPV at the rate 8%. Give me the NPV please. $11,940. Since NPV at the rate 8% is negative, project, not project, you're basically the bond should be rejected. Is it clear? Best. But I hope you understand when I say this. I'll put 1 year, I'll put 2 year, I'll write 1 year, and I'll say this is PV of CO. Price. What I have to actually pay today. Now I am right. Point number 2. PV of CI. Value. what I am ready to max pay today. Is it all making sense? Clear? Okay. Now with this, now I'll just tell you one more thing. Students, what do you mean by IRR? Have you heard of something called as IRR? IRR, na? Yeah, internal rate of return. You've heard of all this? IRR. So sometimes people don't know the meaning only of IRR. They are so engrossed with NPV should be zero, trial error, interpolation, all that. They are so engrossed now. Nobody knows the meaning only. IRR refers to actual rate of return from a project. Okay, students, I want you to listen carefully. For post 9:30 session, there is something I want to tell you now. Can I say IRR refers to actual rate of return? Okay, IRR means what you are. IRR doesn't mean what you want. IRR is what you get. Everybody clear now? What is the actual rate of return? Let's see if you understand my next line. Since NPV at the rate 8% is negative. Ready? Since NPV at the rate 8% is negative, did you understand? Understood? Of course, because do you realize that why is it coming negative? It is coming negative because you are saying na that okay, we wrote here also. See, somewhere you have written. We are writing na. We are not getting 8%. Everyone clear, no? We are not getting 8%. We are getting something less than 8%. Whatever we are getting is called as IRR. Everybody clear? Whatever we are getting is called as IRR. So here, do you therefore realize that since NPV, what is the meaning of a negative NPV? Negative NPV does not mean loss. Remove it from your brains. Negative NPV does not mean loss. Negative NPV simply means the IRR is less than the NPV's rate. You're understanding? At whatever rate you have discounted, no? Yeah, required return, no? IRR is less than that. Everyone clear? In fact, now, just if you want to have a little bit fun, you know what is this 11,940 exactly? This NPV that you got now, it is not a loss. I'll tell you what it is exactly. Students, take your calci. First of all, why I'm saying again and again, it is not loss. It is not loss. Can you see in this project there is a 20,000 rupees profit? Your 80,000 grew to 1 lakh. Now, where is there a loss? You invested in Tata Motors bond. You did not invest in Paytm IPO, na? You're understanding? You understand 80,000 rupees you invested in this bond. It grew to 1 lakh. 20,000 rupee profit you are getting. In that also these people are saying negative NPV. That means the NPV has nothing to do with profit loss. You're understanding? What does NPV have to do? Some people not teach it like this. PV of CO means today's outflow. PV of CI means today's inflow. NPV, today's profit loss. This is bogus explanation. Let me tell you what exactly NPV means. Students, take 1,17,546 on calci. What is this number? You remember this future value? This is what you would have wanted your 80,000 to grow to have grown to, but your 80,000 actually grew to only 1 lakh. Actually, you don't need calculate. Very simple number. Can I say 7? Do minus 1 lakh, na? Minus 1 lakh. do you realize 17,546? Now look at me. Tell me which of the following two sentences is correct. Oh no, I lost 17,546. Statement number 2. Oh no, I am getting profit, but my profit is not as much as I want. It is less by 17,546. Second statement, no. You're understanding? You are not in loss. It's just that your hunger is not getting satisfied. You're understanding? You have the capacity to eat 5 dosas. Somebody is giving you only 3. You're understanding? Like that it is. You're not getting 2. I hope you got it. You are not shrinking. You understand? You are that only. What you want, in that little bit less you are getting. Correct? So profit is there. Your 80,000 did not become 40,000, or 80 became 1 lakh. You wanted it to go 17,000 more. Correct? Now clear the calcs. Remember 17,546 number. Remember. Now take 1 divided by 1.08. Press equal to 5 times. I think we got 0.6806, no? Something like that. Correct? So what you have on your calci is the discounting factor of 8% 5 years. 1 divided by 1.08 equal to 5 times. You reach 0.6806. Keep it on calci. Students, this 17,546 that we are talking about, do you realize is your disappointment after 5 years? Let us calculate present value of that disappointment. How to calculate present value of disappointment? Multiply this discounting factor that you have by the 17,546. Do it please. Multiply by 17,546. You will land up on NPV. Check. Everyone, are you able to understand? What is NPV? You understood clearly. A negative NPV does not mean loss. A negative NPV simply means that I am not getting my 5 dosas. You're understanding? I am getting dosas, 3 or 4, whatever, but it's not 5. I am getting return. The return that I am getting is IRR. But that IRR is not equal to 8%. Everybody clear? That is what I wanted to express through this. Clear? After all of this explanation, I will just want you to remember this point number 2 I have written in red for today's first session. Forget everything else. Those who didn't understand anything, just understand that value is calculated by calculating present value of future cash flows. Everybody clear? Present value of future cash flows. Cash inflows are not outflows, inflows. Present value of future cash inflows. Present value of cash outflow will give you the price. Present value of cash inflow will give you value. Everyone clear? Hello? Following ಅರ್ಥ ಆಯ್ತಾ? ಎಲ್ಲರಿಗೂ ಪುರಿഞ്ഞದಾ? ಓಕೆ, ಅರ್ಥమైందా? For Telugu students, I don't know what it is called in Malayalam. That is the last language to be conquered. I don't know that. Anyways, so now so in your notebooks now we will go for some notes now. Ready everyone? We'll write down something before we go to the sums and all that. Wait, before we go to the notes, let me first see something if I have. Okay, just read this, don't write. Is it making sense? Notes are clear. Why am I using the word theoretical value? Because that value is only on paper. Huh? In the outside, what is reality is price. Got it? Okay, can I go ahead? Okay. I have written some notes here on why present value or something, but that I will this entire thing we can. In fact, if you go to JKC YouTube channel, na, I have shot one video why present value. Like that video is there. But all this only I have discussed, but in short, I have told you a lot in detail. Okay. All right. So these two things now we will write in our notebooks. Everyone ready? So in the notebooks, what I will do is, okay, write down in notebooks module 1, and give heading basic valuation of bonds. Basic valuation of bonds. Basic valuation of bonds. And start writing this first entire 6 points. you done with this? Only 6 points, huh? CMP means current market price. Are we done? Okay. Next line, give heading Y present value. Y present value. Y present value. And you want to write this, what I have discussed here. It will give lot of clarity at the start now of the chapter what exactly is happening here. Okay, so you can write example Tata Motors issues. You can write X limited issues, whatever you want to write, and start. Y present value, Y, WHY. Yes, continue with A point. Yes, yes. Sorry. Higher the risk, higher the required return. That is what is the whole theme. Opportunity cost, it depends on that. So if I am investing in a particular bond, if that bond has a particular level of risk, then with that same level of risk outside, how much I am getting, that is my opportunity cost. Like that. Done. Sandeep, done. Kusuma. RV means redemption value. Everyone done? So what do you think? Concept is clear till here? Everyone? Okay. So now in the notebooks, what you should do is, you have written this introduction to bond valuation, no? You please give this as A. This is part A of the module. Then when you started Y present value, put it as B. And now students, I am teaching you part C. Are we ready? 1 hour to go for the break. Can we start, everyone? Okay. Part C. Now drop your pens and listen. I am giving something to you. Listen carefully. Huh? Five types of bonds. Don't write anything, just listen. Huh? 5 types of bonds. So based on cash flow patterns, bonds can be classified as follows. Point number A, plain vanilla bond. Okay, plain vanilla bond. All right. So students, this first bond, let us discuss. This is a bond, okay, that gives you, how do you get the cash inflows here? CI means cash inflow. You will get interest per period for n periods plus RV at end of nth period. Take your time and read what I have written. You know, a normal debenture. You're understanding the normal debenture, nothing great. Clear? Where you will get interest at the end of every period for n periods. P here, hold on. P means P per. Huh? Okay, this is, I'll just take it here. Interest per period for n years, n periods, and plus RV at the end of nth period. Everyone clear? So students, do you understand valuation of such a bond? V bracket B will be interest into annuity factor plus redemption value into discounting factor. Don't panic, it's very simple. You know what is annuity factor? Every year when you get same cash flows. Okay, I'll give you example. See, listen. In fact, for example, no, I will take up question number 1. Read question 1. How much should A pay to purchase the bond? It's saying how much are you ready to pay basically. So students, for that, can you see it's a bond, 5-year bond. Okay, now that the period is defined, 5 years, 1000 rupees is the face value. Coupon rate means interest rate is 9%, which will be applied on 1000 rupees, and your required rate of return is 10%. Can I say it is at this rate that you will be doing the discounting? Everyone clear? I want to find the value of the bond. Students, how do I find value of bond? V bracket B. What is the theme? Present value of all future cash inflows. Do you agree? V bracket B is equal to PV of CI. Now we wrote na earlier. Hello. V bracket B equal to PV of CI. How to make table? Year cash inflow. Okay. Use your brains and tell me discounting rate is 9% or 10%. Tell me on the chat box. This basic differentiation one should understand. Na? Discounting factor 9 or 10. Thank you. 10%. And present value. Ready everyone? Present value. Now see the screens please. Everyone. We are not calculating NPV. We are only calculating PV of CI. I hope you are listening. Only PV of CI. Now you tell me, if you invest in this bond today, do you understand that you will get 90 rupees every year for the next 5 years, and at the end of 5th year, can I say you will get your 1000 rupees redemption? Think about what I'm writing here. Understood clearly how I got 99% of 1000, correct? And 1000 is the redemption. So how is this different from the Tata Motors zero coupon bond? In Tata Motors zero coupon bond, look at the screen, only this much was there. Now it is a coupon bond. So can I say coupons also will come? No, interest also will come as your present in your cash inflows. Correct? Okay. Do you know how to calculate annuity factor? If you have GT, no, it is most simple. In your calculator, if you have the GT button, it is most simple. See, listen. Discounting factor at the rate 10%, no. 1, 2, 3, 4, 5. 0.9091, 0.826. Now institute nowadays is taking only 3 decimals, so we'll take 3 only. Everyone ready? So 0.909, 0.826, 0.751, 0.683 and 0.621. Okay, these are your 5 discounting factors of 10%. Okay, now do you realize every year the cash inflow is 90, 90, 90, 90 and 90. Do you agree? But what is the shortcut? The shortcut is, rather than doing 90 into 0.909, 90 into 90, rather than that, we should add the entire column and straight away multiply by common 90. Everybody clear, na? So that common 90 I have put here. Now the summation of this I need to put here. I hope you are understanding, right? The summation comes to something like 3.791 if I'm not wrong. Just check what to do, how to calculate summation. Take, for those who have GT on Calci, they should do 1 divided by 1.1 equal to. Once you reach the 5th 0.6209, when you reach there, then just press GT. You will get 3.790778, something like that. You will get. You are understanding now? You will get total. Correct? Those who don't have GT can use M plus MRC. I hope you are understanding. 1 divided by 1.1 equal to, press equal to once, M plus, again equal to 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 M plus, and MRC. Everyone clear? There is third technique also of finding this. If you don't understand GT, if you don't understand M plus MRC, third technique is go in the last page, write down these 5 and add them. You're understanding, no? What to say now? Okay, so done. And always remember, when in the exam, no, when you are calculating this annuity factor, before that just check if any discounting factor is required. If yes, write it down first, because otherwise you'll have to again go through everything to reach 0.621. Getting it, no? Like that. So someone please give me total, no, here how much? 90 into, and please, on when you have taken 3 decimals here, then on Calci also one should take 3 decimals only. Don't take all decimals. Answers will then vary. You're getting it now? Please take round off, no problem. Okay, please get me this answer. Final answer is 341. No, give me final answer. Okay, this is 341.19. Is this correct? 341.19. Great. The next I will tell you 621. Correct? Now when you add this, this becomes 962.19. Students, is this the price or is this the value? Value. Correct? We call it as V bracket B. Everyone clear? Value. This is what you are ready to maximum pay. Now I want to tell you a note. Coupon rate to be applied on face value to find interest, but required rate, this is the discounting rate. I hope you're understanding. Both rates are so required rate na can also be sometimes called as required yield. It can also be called as cost of capital. You're understanding, no? There are different words. It can also be called as cost of debt. It can also be called as opportunity cost. So these are different words, but never apply these rates on face value to find interest. Huh? That interest rate, coupon rate is different. Everyone, you understood now? If you do like this, then gone. Huh? I hope you understood. Huh? So this note also I will want you to write in the notebooks. Okay, just 1 minute. Okay, so students, did you understand this particular thing? You understood this thing? Interest into annuity factor plus RV into discounting factor. Okay, now what you should do is, yeah, please copy this, everyone, please. From where it is pending for point C? Okay.